Of course, you have centralized finance and traditional finance. These are financial instruments, but people know what finance is, right? Investing, interest bearing investments, exchanges, stock markets, all this good stuff, and specifically the functions that a bank would provide. Well, historically, these financial institutions and instruments have been centralized, and we have to trust these parties in order to do business with them. Now, sometimes they're corrupted, sometimes there's funny business. I remember recently Wells Fargo was like shaving from people's checking accounts or something.
Right.
Like, wow, Wells Fargo. HSBC was engaged in money laundering for Mexican cartels. Like, wow. But on top of that, a lot of brokers and agents and centralized financial institutions, more so than serving their clients, they are seeking profit through fees, right? There's fees for everything. So now with the advent of cryptocurrency, which is decentralized, now we have decentralized finance. And specifically what this means is rather than doing business with a centralized institution that's going to take a fee at every single level, whether you're buying it or selling it or whatever, and also you have to trust that they're not going to be corrupt and that they're going to be good stewards of your money, and they're not going to be investing more than they really have on or doing fractional reserve banking. We now have the ability to do these types of financial instruments, but instead of doing them with a centralized company, we're doing them with what's called a smart contract. So some of these cryptocurrencies and blockchains, like Ethereum, for example, they're what's called a Turing complete blockchain. You don't need to know that term, but I learned that term a little while before I did the workshop. I was like, oh, I didn't know that's what that term meant. But essentially, that means it's a highly programmable instrument, right? So now we have a blockchain where we can write computer programs on top of them. And a smart contract essentially is a contract that's coded into a blockchain. The benefit of this is that nobody controls it. It's open source, so anyone can see the code. People don't know what JP Morgan or Goldman Sachs are doing when they're trading and all this derivatives and credit default swaps and all this nonsense that got us into trouble, I guess, over a decade now. Wow. So now we have decentralized finance. So what's the practical implication of that? One of the biggest uses for that is for folks that have amassed cryptocurrency. So let's say that you've managed to amass $100,000 worth of cryptocurrency. But now all of a sudden there's an emergency, or perhaps you and your spouse are about to have a child. So you want to add on a new room for the nursery. Well, you know that cryptocurrency is going to continue to go up in value, more than likely. I don't know it for a fact, but chances are it's going to go up. Right. So you're hesitant to sell your cryptocurrency, but you've been putting so much of your money into the cryptocurrency that you have a whole lot of cryptocurrency. So one thing that people can do now, and this is what I specifically did recently, you can take your cryptocurrency, you can put it up as collateral and lock it into a smart contract. That smart contract will then generate what's known as stable coins. These are cryptocurrencies that are specifically pegged to the US dollar, right? So you put your cryptocurrency up as collateral. This computer program, this decentralized smart contract, then generates stable coins for you. You then take your stable coins, you convert it to fiat or US dollars. You spend the money for the construction, or maybe it's even the down payment on a construction loan, but ideally you're doing it without the banks. And then you do your construction. And now, instead of paying back a bank with substantial amounts of interest, you pay back the smart contract. And as soon as you pay back that stable coin that was loaned to you by the smart contract, you get access to your cryptocurrency again. This is really groundbreaking stuff. And that's just one of the use cases. You can supply the cryptocurrency as collateral, and then you get a loan. Now you pay interest. They have different names for it, but essentially it's interest with that APY. You pay interest, but also the money that you supply is collecting interest as well. And so oftentimes those either cancel one another out, or you're just paying, 1% or less than 1% on your money, which is oftentimes a better loan than you're going to get from old JP Morgan or Goldman Sachs.